I think many people know ARC quite well, but I'll give it to Myron for a few minutes here to have some opening remarks on the company and key messages that they want to make sure they get across, and then I'll turn it into Q&A after that. And I do have the web app up here, so if you want to submit questions, feel free on the app, or if you wanted to raise your hand, I'll try to look for you and make sure that we get an interactive session going. So with that, I'll turn it over to Myron, and thank you for being here.
That's good. Yeah, so we prepared a really quick overview here, and I'll just do that and then leave the bulk of the time for Jamie to ask me all the skill testing questions. So thank you for being here today, and thank you to CIBC, and Jamie, thank you for hosting us here. So I'll just kick off. I've got 3 slides, so it's probably in the category of fantastically short presentation, which people seem to enjoy. So, to give a little bit of history of ARC is what I'd like to just do on this first page. I think a lot of people are really familiar with ARC now, but the punchline is from 180 million IPO. We've gone over distributing $6.5 billion of dividends. So there's always questions, even this morning on the one-on-ones about, paying a dividend. So it's something we understand well, and we've been doing for over 2 decades, and have accumulated quite a total of dividend distribution now. We look forward to this summer bringing on another large project in Northeast British Columbia, and that'll come on, you can see in the map there, in the area called Dawson. That'll be Dawson Phase 4, so our 4th expansion project just inside Northeast BC by mile 0 of the Alaska Highway for our American friends. And we'll be bringing on another 90 million a day, 7,500 barrel a day project. Upon the completion of that small area that ARC manages there, you see Dawson and Sunrise, Parkland Tower. That ARC will be producing through company-owned infrastructure about 5% of Canada's gas from that little area there, which speaks to the efficiencies of the business nowadays and why we got out of the old business into the Montney, and you're really starting to see the efficiencies shine. So we'll be, I think, number 4, number 5 on Canada's natural gas producers as far as size. And then we continue to focus on light oil and condensate, and continue to be a top 10 producer in Canada. Give you a sense of magnitude of the resource. We booked about 4 TCF of gas, and just on this map in BC, there's over 105 trillion cubic feet. So even though I've been talking about the Montney since we drilled the first well in 2005, we're only booked at about 4% of what's there. So 2 decades also of maintaining a strong balance sheet. If you want one of the hallmarks of ARC is really focusing on strong balance sheet, and the more experience I get and the more runtime, I guess I've got lots of experience now at 35 years or something, but you just build your conviction around balance sheet every month you work in this industry and see the volatility. So that continues to be important. We manage our debt to trailing in that 1 to 1.5 range, and we've just gone through a massive transformation of the company and maintained our dividend and our balance sheet strength through that whole period. So looking forward in 2020, capital budget of $500 million. I'll talk a little bit about it on the next slide, and pay out our $200 million dividend, and keep on rolling. We're really proud of our capital discipline, technical innovation at our company, and maybe we'll talk about that in the Q&A. So that kind of gives you a quick update of where we're at. Our share price is just over $7. Our dividend at 60 cents, which has been, I think we're in our 5th year there now. The yield is, I call it eye-popping, over 8%. And so that's kind of where we sit. We haven't issued any equity for 5 years now, and have taken the company and increased the size of it by 50%. Well, we've done all of that. On the next slide, I'll just quickly show you where we are in our capital budget. And we've just completed some large audacious goals, which were building out company-owned infrastructure at Sunrise, producing a quarter B there now and owning all that infrastructure. As I talked about Dawson, at the end of mid-year this year, we'll own all of that liquids and gas infrastructure. That's all bought and paid for in the past 3 years. Friendly reminder that we sold Saskatchewan in Q4 of 16. Essentially, we had a pre-funded capital journey to pay for all that infrastructure. Our debt's $300 million lower than it was at the start of 15. Our operating costs have gone from $9 down to the mid-4s during this transformation, and we own all that infrastructure, and we're producing in that 150,000 BOE per day range. I spoke about the $200 million dividend and the $500 million capital investment required this year, and all the analysts that are following us comment on our ability to do that out of free cash flow. So we've been thinking about this for a long time. The journey to free cash flow is in every second email that you get every day in 2019. That's a journey we've started 4 or 5 years ago with our build out of infrastructure, and we're enjoying that this year. So just to summarize on our priorities, how we manage the company, this is really just a little bit about the pecking order. Think about the balance sheet, keep returning that dividend to our shareholders. We are a commodities business, so it's all about cost structure. That's why the operating costs are so important. The replacement costs, we continue to find oil and gas at very competitive and low rates in the Montney. We'll be doing our reserves press release on February 6th and our year-end results on February 6th, so you can get some insight into that in a couple of weeks from now. Cost structure is everything to us. And as we move to free cash flow the next couple of years, we continue to invest and incubate our next growth projects. So a lot of people asking about Attachie, which you could see on that map. And the building blocks are in place to start to have a nice capital competition for the next investment opportunities at ARC with 2020 and 2021 growth and dividend model in the bag. We're already working on our 22 and 23 plans. And the simple way to have a look at that is you can see kind of my simple theme here: bigger company, less capital. The reason I'm able to say that about the less capital on the bottom stack bar is there was a lot of investment in infrastructure the past 3 years. So this year, as we move from 19 to 20, our capital's down 29% on the chart, 700 to 500. But we're getting the results of that pre-investment, so the production will grow 14%. That's with Dawson running half a year this year. So without doing anything else complicated, just running Dawson for the full year in 2021, which would be the far right graph, you continue to have production growth of 6 to 7% in combination with the yield now that you obtain through the dividend, and the sum of those two are the returns that we offer to shareholders and potential shareholders. So there's our value proposition going forward the next couple of years, and we're really pleased where we are now as we've completely transformed ARC. I like to say we're a 23-year-old company that IPO'd in 1996, but really we're about a 9-year-old company with all brand new assets because we sold all the rest. So that's our journey in a nutshell, and look forward to the Q&A.
Excellent. Thank you for that, Myron. Maybe we'll just kick things off with, I can do it in a couple areas here, I guess, but I guess on this slide, if we think about future infrastructure, ARC is a company that's known for owning and operating all of its own infrastructure, but that of course comes up with an upfront capital commitment. I guess how do you weigh the benefit of third-party ownership versus internal ownership of your infrastructure, and would the company ever look to monetize a portion of it?
Yeah. So monetizing our infrastructure isn't a focus. We just worked really hard the past 10 years to build out this base cash flow of our company. But I think it's important to say that almost every asset that we've commercialized, we actually started out using third-party infrastructure. So when Dawson was small, I'm sitting here bragging about how it's 300 million a day, but we actually started with 440 million a day to a West Coast plant, which is Spectra, which went to Enbridge, which is now North River. So that's the Dawson journey. So on our Septimus, we actually have de-risked Septimus through some Shell infrastructure. Our Attachie prospect right now, we're actually piloting it through Petronas infrastructure. Sunrise, the early days of Sunrise, we actually determined the commerciality of that project by using Murphy infrastructure, which was later sold to Enbridge. So we're all about the returns, Jamie. And once we understand the reservoir and can have a real good understanding of the well performance and the commercial terms of the marketing in that area on liquids and gas transportation, and move to commercialization, we believe over time owning your infrastructure creates a lot of value. But we don't have our head in the sand that if you get a good deal, you do that. Murphy gave us a really good deal to process there, and Sunrise was very profitable even with the midstreamer. So we look at all the opportunities.
Gotcha. Okay, a couple of questions from the web here. I guess on that note, with respect to infrastructure, we saw, one of ARC's peers, Tourmaline, looked to, spin a royalty and also introduce a new vehicle called Topaz. Just audience member wanting to get ARC's thoughts on that type of a deal.
It's probably not the audience member in the back there. Yeah. So I have a lot of respect for the Tourmaline team, and I don't want to profess that I understand everything about that deal, but those are really smart guys, and the combination of that, I would say from just looking at it as an outsider view, because I'm an industry member, but I don't work there, there's probably a couple more dance moves and acquisitions to be made to complete that strategy, to add that value. As far as where ARC is in our journey, we're really focused on our organic development opportunity. We were an early mover in building the Attachie play, for example. That came actually after the old Tourmaline Duvernay sold that play, which is right beside Sunrise, for billions of dollars. We built Attachie just north of that by investing 40 million in buying land. And then we did another deal with another super major to build that 200,000 acres. So our costs in there are very low, and we're about half the size of the other company you're talking about. So we have a long ways to go to continue our organic development, Jamie.
Got it. Yeah. On that same line, another question off the web here, but ARC has a lot of assets to work with here: Attachie, Dawson, Sunrise, Tower Parkland. How do you weigh organic opportunities versus M&A? And is M&A something that is interesting to you this year more than others, or do you just have too much organic opportunities that you're focused on that?
Yeah, there's always learning, and our biggest learnings around capital efficiency. And if you look at our capital efficiencies, Jamie, if you look at our 5-year plan, we're able to maintain our oil and gas production base by investing about $8,000 for every BOE of production, which is our combination of oil and gas. 5 years ago, that was about 14,000 a BOE. So you just look at those efficiencies of building your own business. So if you look at Attachie, which is quite complicated, there's condensate, oil batteries, gas plants, infrastructures, a lot of new marketing access connections required. You can build that whole thing for around 14,000 per BOE per day, just to make it simple. Acquisitions would still be 2 or 3 times that cost. And when you look at the opportunities for our shareholders, they're best served by investing in the highest profitability projects, which are the ones we're designing and building ourselves.
Right. Maybe Attachie, since we mentioned that, I mean, we've seen in public data some great well results out of the new pad that you guys have there. I guess, how would you characterize some of the results you've seen thus far with what you can comment on? And when should we think about the next, line in the sand, or next, I guess, potential marker for maybe a sanctioning decision for when Attachie would go forward?
Yeah, so Attachie, just to kind of back up the train a little bit, why we like Attachie so much is we're into an area where it's highly overpressured, 60 to 80% overpressured. That means Mother Nature drives the production to the wellbore very efficiently. We're also finding wells that have about 300 barrels of condensate per million standard cubic feet. So super liquids rich, 40 to 50% liquids production for every BOE. So the condensate is very valuable. It's 50 to 55 API, so it's right on the cusp of light oil. And because of that little bit lighter API, it's flowing through the reservoir very efficiently. So we get boomer wells out of that. And that's, when you look at the opportunity in Attachie, we have 30 trillion cubic feet of gas there and about 9 billion barrels of this light oil and condensate. So that's what's attracting us to that investment. So there seems to be this feeling that, we sort of stopped on Attachie, but I don't think anything could be further from the truth. We have cut our capital this year to 500 million. But last year, when it was 700 on that chart, we actually spent $80 million on Attachie. We've drilled some really interesting wells where we spaced them out quite wide so we don't have the parent-child that everyone's talking about. They're wide enough that they don't interfere with each other. And we're hoping to see wells that are very similar to just drilling a single well in the reservoir, which will give us about 400,000 barrels of condensate per well and 2 to 3 BCF of gas, which is about a million BOE type curve, but half condensate. So that will be very lucrative. So that's what we're after, Jamie. So the investment in Attachie is going at the right pace. 80 million last year to test the wells. It was actually 30 million in this $500 million budget this year. The road has been built in there. That cost $16.4 million. So we just kind of chipping away and getting things done. The approvals, which sometimes can take a long time, have been secured for the gas plant and processing for 180 million. So that would be bigger than we would build. But we like to get our regulatory approvals for something that's supersized and then decide how to phase it. Like Dawson, we had 180 and we built 290s, for example. So that check mark on approval, check mark on the wells happening. And now what's really important in that area is the commercial terms around the liquids marketing, Jamie. So there's Pembina up there, and there's a lot of increased activity for people trying to get more business on the liquid side. You hear about rail cars and Ridley Islands and more propane kind of feedstock refining, upgrading projects in Fort Saskatchewan. There's all kinds of value chain going on the liquid side. So before we commercialize, we want to really be certain that we've set this business up with the lowest cost structure for years and years. And that's all happening as it should. So everything's happening. There's just not a big flagship spend on it right now because we're watching the wells.
Got it.
Yep.
Paul?
Do you have a rock or technology competitive advantage, or is just focusing on capital efficiencies, managing IT costs?
Yeah.
Become the best.
I think there's 2 or 3 companies that kind of continue to lead on efficiencies, and what really gives up a leg up is that we incorporate our learnings as we go. So we've gone to Attachie, and you look at that huge, that's as big as the city of Calgary, from Airdrie down to Okotoks, and east to west is almost similar, 200,000 acres. And we've been drilling wells and learning from that well, and then drilling a handful and learning from that well to get the best knowledge going forward. So we use what and great rock. You always have to have great rock. So our map is a couple pages back, but if you look how we're positioned on that northwest, you can kind of see that 45-degree angle of the lands. That's where our geoscientists felt that the oil and gas and dry gas, that there was an intersection of that. And you can get dry gas or volatile oil, NGLs, or more up dip kind of oil. And then you start to learn which one of those is your money-making zone. So there's this iterative technology, geology, learning that goes on. But we use a lot of technology. You know, right now, you know, there's something called dark vision where you go out and you're looking at how does the frac sand alter the perforations under, you know, so you're going in there after and you're learning. We've been using microseismic, you know, for years. And just testing. The clusters are all the rage. I think a few of us in that area have been doing these cluster fracs for quite a few years, actually. So I like to think about, I call it organizational learning, and incorporating that learning. That's just a fancy CEO word for saving money. Yeah. So.
There's a similar question on the web, so I think we'll leave it at that with respect to Montney applications. Maybe on this slide, Myron, you know, you guys point to capital expenditures, you know, going down pretty significantly this year. How should we think about the use of free cash for, you know, the years going forward? Like we have our estimates show ARC at a very competitive free cash flow yield this year and next. You know, how do we think about where the free cash flow spend goes to in these upcoming years? And, you know, should we think about, you know, a further reducing capital spend profile as ARC moves forward?
Yeah. So that backdrop of that balance sheet strength that we have a lot of conviction around, I really think this year the market, we've been talking about how cheap we can sustain, but this is kind of a show me year. We'll show the market that we can, you know, sustain our company and finish off Ante Creek and Dawson for this 500 million, and hopefully forward curve willing and your model willing, we have free cash flow. But it's a pretty simple answer for us. We take that, pay our debt down, and if you can picture doing that for a couple of years, that just gets your balance sheet stronger and stronger, and then you can sanction something like Attachie and be very confident about developing it.
Okay. Great. Maybe a question on ESG. You know, that continues to rise in our conversations with investors. It's certainly gaining importance. A lot of the focus has been on the, you know, obviously the environmental side for energy producers. I mean, ARC has been a leader on this front for quite a long time, and you guys have put out a report every couple of years for a while. Can you expand on some of ARC's initiatives in this area this year, and you know, also maybe where you're differentiated from other producers?
Yeah, so, you know, background on ESG, actually ARC in 2000, which is 20 years ago, before all this carbon disclosure project and all of the acronyms that we all have, there was a thing in Canada called voluntary climate registry. So you voluntarily kept track of your emissions. So we participated in that. We won a leadership award in Canada 20 years ago on this. So I like to, when I talk about ESG, just this is fully integrated in our business. It's not a buzzword to us. You referenced the sustainability report. I think we've done those for 12 years more formally. So this is, and so, you know, so we feel like we're really ahead. And then, you know, on the question about differentiating, as you learn about ESG, you start doing more and more real things. And I think learning, and I know different CEOs, we're all working on this together as well. We need to start communicating more specific examples that we do really well and just make that resonate more. And, you know, when you hear something about net zero in 2050, even for me, I'm like, that's a long ways away. You know, I'm going to be 78. Maybe it's 88, I don't know. But yeah, Mike, okay, Mike's going on older. You know, so we make this real today. So something that's real today is our Sunrise gas plant. I talked about it producing a quarter of a BCF, a lot of gas, natural gas every day. That plant completely runs off of the power that's generated from the hydro dam on the Peace River. It's only 20 miles away. There's really no carbon emissions, all electrical motors running this thing. The emissions are actually sequestered into the reservoir. That thing's pretty close to net zero already. So as we start communicating more I know everyone's talking net zero 2050. You're going to see in the ARC reporting, we're writing our 2020 report now, more examples. Last time I was up in the field, and everyone talks about methane leakage. A lot of that used to be old instruments that would use the pressure from a well and run an instrument and poof it out to the atmosphere. But if you go to, it's 10 years ago already, but we need to communicate. There's instrument air compressors that run all these instruments, and these instrument air compressors actually run off of solar. Our industry is probably one of the earliest adopters of solar. Those panels have been out Brooks Medicine Hat area since I was 25. So that's been out there 20 years. So there's lots. We use fuel cell technology up north where there's not enough daylight for solar. That fuel cell technology actually generates minor amount of current to run instrumentation in remote areas. So there's lots and lots of examples. We were just running a rig off of LNG instead of diesel here the other day. There's some good work by some other companies to run rigs off of natural gas. So there's just oodles and oodles of real things, and I'm going to be working to communicate those more in our written and spoken opportunities. Thanks, Jim.
Maybe on natural gas pricing here, I mean, we've seen, NYMEX obviously in a tough spot right now with where winter is headed to. And we've also seen the cost curve in Western Canada, continue to get lower for a lot of different operators, not everybody, but certainly ARC is very low on the cost curve there. I mean, how should we think, or how does ARC think about pricing in the local market going forward? And, is LNG ultimately the only real fix for helping pricing, do you think?
We think a lot about diversification, so just to help understand how we've been marketing our gas, we're selling in Northern California at Malin, we're selling at Chicago right now, so 10% to California. That's going to increase by 50 million a day mid-year this year. We're selling to Ventura and Chicago into the Midwest. That's a consuming zone. We like to think about who's consuming the product versus producing the product. We're selling 5% of our production down Dawn to Toronto. So that diversification has worked really well for us. We also sell at home. It's a strong market. It's cold here. and that market's worked out really well for us the past few months. We've actually set up our strategy so there's more gas available to sell in Western Canada the next couple of years. So if you look in our IR deck, we show all these long-term commitments to all these different destinations, and you'll see an increasing amount available to market at home, and that was pretty deliberate as we saw TransCanada easing the kinks out of the system and better connectivity that we could market more. So that's working out well. But I always remind our team, we're in the commodities business. It's all about cost structure. We don't, this winter you could almost say, well, warm European winter, it's been pretty warm in Asia, and that connects, we're now have to think globally, not just continentally about gas, and how does that back up to LNG exports, which is 10% of the US gas out of the Gulf of Mexico, and how does that back up into NYMEX? So our marketing meetings are complicated now, but when you back it all up, you look at Sunrise, we find that gas for about 50 cents an MCF. That's about the same as the Marcellus. But where the Marcellus, we think about competing with the Marcellus every day because that's, twice Canada, just that one geographic area. And so we dive into the cost structures of our, so think of that group of Range and Cabot and Antero and that whole group. Well, they generally use midstreamers. They've taken out pretty expensive pipe to get to market. They pay 20% royalties to freeholders. In Canada, at ARC, we own our infrastructure. Punchline is we operate that whole thing for 30 cents an MCF today, cash costs. It costs us 27 cents to get from Northeast BC down to AECO. So for 60 cents, that business is making a penny. You compare that to the Marcellus, the average cash cost, forget the F&D, that whole group is $210 US. So this is how we ultimately risk manage. You've got hedging, you've got balance sheet, but the cost structure of your company is critical. then that creates the opportunities to look at LNG. I'm getting to your question eventually here. You know, for industrial load, all those opportunities, Jamie.
You bet.
But LNG's great last year, and it's not perfect right now either. So I have to think long term too.
Okay.
Yeah.
Myron, thank you very much. That's all the time we have, but appreciate your insights as always, and thanks for being here.
Yeah, you're welcome.